Okay, hey everyone, thank you. First, I want to say my name is Nick Maggiulli. I'm the Chief Operating Officer at Ritholtz Wealth Management and the author of the blog of dollarsandData.com. And I've also come out with a book about a year ago called Just Keep Buying, Proven Ways to Save Money and Build Your Wealth. And I just want to thank everyone at the Warsaw Passive Investment Conference for inviting me to speak today. And my talk today is on the future of retail investing and how to grow your wealth in the 21st century. It's kind of a two-part talk. And it's called We Are All Investors Now. And before we can talk about the future of retail investing, I think we need to talk about the history of retail investing. How did investing get to where it is today? And to start, I want to ask you guys to think of one question. That question is, what was the first investment? What do you think was the first investment in human history? Was it gold? Was it like some trade route that was funded in the Middle Ages, where someone, gave someone money to, finance a trade route? And I think the answer is no, it goes way before all of that. And I think the first investment in human history is actually food preservation. This image here shows some Native Americans hanging out some buffalo meat to dry to turn it into like jerky, which they would then eat in the future. And if you think about what food preservation is, it's giving up some sort of present consumption to have future consumption, right? You're giving up, instead of eating all this meat now, you're saving it today and bringing it into the future. When you think about what investing is, why people invest, right? They're taking some of their extra savings they have and they're giving up that present consumption to have some sort of future consumption. Whether that's more future consumption or just the same amount of future consumption is irrelevant. That's what investing is. But this really didn't take off as, investments in this form didn't really take off until the advent of agriculture, right? This is the first time in human history where we had surpluses. We had more than what we needed, right? So we could take that excess surplus and store it for, a rainy day or something in the future. However, most of the investors historically were people like rulers, kings, religious leaders, right? You can imagine something like a Roman warehouse of sorts. This would have been filled with things like wine, olive oil, grain, for in case of a famine or something. But who was investing this? This was all being done by rulers. The ruling class were the investors of this day. Yes, individuals probably could save food and stuff like that at the local level, but there was no mass level of investment, right? Most of the investments, at least at a societal level, were done by the ruling class, right? So what happened? When did we start going from like the rulers of society were investing for us, basically, to a society where individuals could start investing? And I think this really starts to take off in the Middle Ages. And so think of a place like Venice, right? Big port city, lots of trade happening, a lot of merchants, right? And I think here's the first time where people can start investing in things, and mostly the rich, if we're being honest, were investing in different ventures to grow their wealth. And one of the first kind of contracts that came about where people were actually investing in groups together was something called the commenda. Now, what the commenda was, it was basically just an agreement between a group of people. So imagine I'm rich in the 1500s. I get a couple of my rich friends together and we say, hey, we're going to finance a trade route. And so we pool our money together. We, let's say, rent a ship or we buy a ship. We hire a crew. They go do some trading for us and we keep some percentage of the upside. Let's say 40%, right? Something like we're going to keep 40% of the upside. Everything else will go back to funding, paying these people, et cetera, right? So we had some sort of upside in the venture, a percentage upside, but our downside was only the money we put up, right? It was a limited liability. The most we could lose is whatever we paid initially into the commenda, into this contract, right? That's kind of where this all started. But this kind of process of, having these individual commendas, these individual agreements between groups of investors, which is like a form of early private equity, if you want to think about it, this eventually evolved into what became the Dutch East India Company, right? Which was the first, public stock in history. And the Dutch East India Company was on the Amsterdam Stock Exchange in 1602. It was set up to trade with a company in India for all the spices, the spice route, and all that type of stuff. And that's kind of where investing really went from like these individual private contracts to being something a little bit more public. Once again, though, this was only really done by the rich, right? So if we think of this in sort of like a timeline of history, like how did investing evolve? Let's kind of walk through everything we've talked about so far, which is like 20,000 BC, who could invest? Basically nobody. All the investments of any sort were just food preservation. It was always local. Like it was really just food you're moving through time, right? Around 2000 BC, all the investors were kings, rulers, things like that. They did start acquiring other types of goods, not just food. They were, holding gold and stuff like that. So it was like the ruling class, about 4,000 years ago, that's who was investing. About around 1500 AD in the Middle Ages, the rich start getting involved. I think this is where things start to take off and becomes much more like the modern day investment, where people are putting up money hoping to, gain even more wealth in the future. And today, though, there's been a massive shift where anyone can be an investor. You could be an investor. I am an investor. I'm guessing many of you are actually investors. And so what happened? What was the big shift from the Middle Ages to today? Why are we even having this conversation? Why is there a Warsaw Passive Investing Conference? All of this kind of comes back to what happened in the last, let's say, 500 years. And I think if you really, analyze why are we talking about investing? Why is it taken off across the globe? Why is, everyone investors now? I think the main reason comes down to life expectancy. And so this chart here from our World in Data this map shows life expectancy across the globe. And the global average, as you can see here at the bottom, was about 29 years across the globe. And what's more interesting about this chart is that there isn't that much of a variation between different continents. Yes, Africa is a bit lower at 26 years compared to the Americas at 35, but that's not that big of a difference in the grand scheme of things. And as we march forward in time, you'll see why. But look, 1800s, this is the Thomas Hobbes quote, I believe. He says, life was nasty, brutish, and short. So for a lot of people, people died younger, children dying in childbirth. We're going to get into that in a second. It was just a tougher life. Now let's fast forward 150 years to 1950, and let's watch how life expectancy changes, right? So the global average goes from 29 years to 46 years. We see North America has shot up considerably. It's almost, I think it's over doubled. Yeah, 35 to basically 70, right, in the course of 150 years. Most of, Europe has shot up in terms of life expectancy. Africa is shooting up considerably. You're seeing a lot of progress in terms of life expectancy around the globe, right? Now let's take another jump forward, another 65 years into the future. Let's go to 2015. And now the global average is 71 years, right? So we went from 29 to 46 to 71 in the course of, 215 years. That is a huge change in how long people are living across the globe. And you can see even places like Africa where, yes, now there's a bigger difference. North America, life expectancy is 80 years. Africa, it's only 61 years. Yes, there's a much bigger difference there now, but still it's 60, right? You're seeing this huge jump across the globe, right, which is showing progress. Now, the thing to note, though, is remember, if I don't know how many of you guys know, a little bit about how life expectancy works. It's not that, going back to this chart, if the life expectancy was 29, it's not like everyone lived to 29 and then dropped dead. That's not what was happening. There was a lot of people that died in childbirth or died in infancy, or young children, and that's bringing the life expectancy measure down. So life expectancy is looking at lifespan, but it's also including childhood mortality. So a lot of this decrease is a decrease in childhood mortality. So if we go back to here, we can actually see what that looks like. So this chart shows the child mortality since 1950, right? So it shows the share of children born alive but dying before age 5 across the globe. And you can see it's dropped pretty considerably. And if we were to zoom out more, we would see that this is actually the decline's much steeper than this. This is only since 1950, which is between our last two charts that I showed, right? So we're seeing a decline, but the decline's actually even more massive than this. And so this next chart actually shows child mortality kind of historically, and the data is not as good on this, but there's a lot of data points across history. What this shows is the youth mortality rate in red. This is the share of children that died under age 15, right, before their 15th birthday, and it's roughly 46%. We'll just round that to 50%. So 1 in 2 people historically would have died before their 15th birthday. And then this blue line shows infant mortality, people or children that have died before their first year of life, right? And this is around 26%. We'll just say it's 25 to make this math a little bit easier. Let me just kind of paint an example of what this means, right? If you had 4 children historically throughout most of human history, 1 of them would have died before 15, 1 of them would have died before their first birthday, and 2 of them would have survived, right? Given a 50% youth mortality rate and a 25% infant mortality rate, assuming they're completely independent, right? But all of this changes, starting in the 1800s, Industrial Revolution. You can see the global youth mortality rate plummets. Today, or 2017, it's about 5%. And the global infant mortality rate is only 3%, right, globally. This is what I'm talking about. This massive plummeting here has had a huge impact on on life expectancy around the globe. But it's not just, life expectancy is going up because childhood mortality is dropping. That is true, but there's people are actually living longer as well. So there's these two components, right? And so we don't have as much data on how long people are living, but we have a little bit of this. And so there's some actually good data out of the United Kingdom looking at people from England and Wales. And there's going to be a lot of lines on this next chart, but I'll explain what they mean. So the line to focus on for now is just this red line, life expectancy at birth. That's all the figures we were talking about historically, all the life expectancy figures, that's showing this here. So this shows, in England and Wales in 1841, life expectancy was about 40 years, and it basically doubled by the year 2013. It doubled to about 80 years over this time period. But the line I want you to focus on now that we've kind of talked about, life expectancy, is life expectancy for a 5-year-old. So say you made it to age 5, how long were you likely to live? This is a better measure of lifespan because you got through those first few years where, you're more likely to die due to disease and all sorts of things. So let's say you make it to age 5, right? And it's, you're in England and Wales and it's 1841. You're likely to live to age 55. In 1841, you're likely to make it around age 55, which is not really an old age, but it's like a middle age, what we call a middle age today. But back then that was old age. And you can see over time, from 1841 to 2013, this shot up to about 82 years. So roughly, it's not 85 years, but roughly we got about 30 more years of lifespan over time, right? And so what this chart shows and what's interesting is not only is everything going up and to the right, which is good, we're seeing improvements across the lifespan. Even 70-year-olds are living, someone who made it to 70 would have lived to about 80 in 1841. We've given them at least another, 6 years of life, even despite everything that's happened, right? So this is really interesting because you see everything's moving up and to the right, but also the lines are getting much closer, right? So there's a kind of this convergence. And what's happening as a result, it just means that people are having longer lifespans. And I think this next chart shows this a little bit better, illustrates it. This shows survival curves of people born in England and Wales from 1851 to 2011, and this is a projection to 2031. Now, let me just give you an example of what this means. This is, for example, showing the share of people surviving to a particular age. So in 1851, roughly 25% of people lived to age 70. 1 in 4 people lived to age 70, right? So people over age 70 were quite rare in the 1850s. They were not a very common occurrence. But now think about today. It's over 90%, right? Over 90% of people today live to age 70. So what's happened? Like between this chart and this chart, what's really happened is that we've added a couple decades, let's say 3 decades probably, to everyone's lifespans, just collectively as humanity. So in a sense, we've invented old age as a cohort. Like old people as a cohort didn't really exist in the 1850s. They didn't exist in the 1700s, the 1500s. Yes, there were some old people, but there was not a massive amount of old people. So because of that, because there's far more older people today, we have, we have longer lives. That means that there's more certainty about the future. That's kind of what this whole thing is about. Oh, we're going to live longer, so we're more likely to be alive in the future. And if we're more likely to be alive in the future, we have more certainty that we're going to be alive. That means more demand for investing. So the long story short of this is the reason why we care about investing and why it's become such a thing is because people are living longer. We actually need to invest for our future to save, right? And so more demand for investing means things like more demand for stocks, right? And so you can imagine like this is why, individuals are investing today because they're trying to preserve and grow their wealth over time to compensate for the years when they won't be able to work. Now, there's a lot in most of Europe, there are great social safety nets, which is great. So you don't really need to invest as much as you might need to in the US where the social safety net isn't as nice. So that's one, kind of positive why maybe the investment culture in Europe generally is not as strong as it is in the US because frankly, you don't need to invest as much because the government will take care of you, which is a very different philosophy and framework that we don't necessarily have at the same level in the United States. We have Social Security, but that's about it. So think about what this means, right? Like people said, hey, I need to grow my wealth, so they started buying things like individual stocks, right? They would buy things like Amazon, Tesla, Apple. Now, of course, these companies weren't around in the early 1900s or in the 1920s when people were investing, but you can imagine, General Electric, among other companies that people could have been buying at that time, right? Standard Oil, etc. But the reason, what's happening over this time period is people are buying individual stocks because they want to grow their wealth. And then someone comes up with the great idea, instead of owning these individual companies, why not just own all the companies, right? Why not own all of them at once, right? This would be less risky. I don't have to deal with the idiosyncratic risk, the specific risks related to Amazon or Tesla or Apple. I can own all of them. And so if one of these companies drops 20% in a day, I don't really lose that much money, right? And so that's kind of the idea behind, mutual funds and index funds. You're owning the entire basket. You're owning the entire, let's say, S&P 500 if you're owning a basket of US stocks, right? And then someone took this idea and said, well, instead of just owning all these individual companies, why don't we extend this even further? And why don't we say, let's own not just individual companies in the US, let's own individual companies around the world, right? This is kind of the big jump forward. It's like, instead of just focusing on individual companies, let's own things more globally, broad-based ownership, diversified ownership. And you can see this clearly in the data. In this chart here shows the ownership share of the corporate equity market of just stocks in the United States, who's owning stocks over time. You can see in 1950, 90% of stocks are owned by individual households, right? This big kind of like, I don't know, like teal color here, turquoise color, whatever you want to call it. This here is the household ownership. It was 90% in 1950. Today, it's only 34%. A lot has changed. Pensions have taken over in a big way. Foreign investors have come in. But one of the big things to notice is mutual funds and ETFs now make up roughly 30% of the market. And what is this? This is cheap diversification. This is people pooling money together and buying a host of companies at once. Mutual funds are very rarely invested in just a handful of stocks. They're usually quite diversified. They own many positions, same with ETFs, right? So you're seeing this household shift from owning, the equity market where they're owning individual stocks to owning them in a diversified way. Now remember, mutual funds and ETFs are owned by households anyway. So this is still household ownership, and same with pensions. A lot of pensions are owned on the behalf of households. So this is still really household ownership. It's just done through different vehicles. So given what's happened, you can understand why we are all investors now. Like the change in life expectancy has led to this, right? So given that we're all investors, the question is, well, what's the future? What's going to happen next? What's the future of retail investing? And so going back to like a timeline that we've talked about, like what comes next? In the 1950s, it was people owning individual stocks. In the 1970s, index funds started to take off. By the 1990s, it was ETFs, exchange traded funds, which many of you know. And what's the future? What's the next step? And I think the next step is what I'm going to call customization. And I think this is the next kind of way we're going to think about investing, and how we're going to look back and think about what we're doing now is a little archaic, and I'll explain in a second. But let's start with like a hypothetical, scenario. Imagine a portfolio designed for you, right? For your specific life circumstances, right? So let me give you an example. Imagine you work in the oil and gas industry, right? And you're working in the oil and gas industry, which means all of your income comes from the oil and gas industry. Now you're like, hey, I want to invest for my future. What would we do now if you're like, let's say, living in the United States? We'd say, okay, buy an S&P 500 index fund, own this collection of companies, etc., right? But your income is already derived from this, basic materials, oil and gas industry up here already. So why would I also own that? You're basically doubling down in some way on oil and gas. Not only is, you can think of your income as like a bond payment that you're getting from working, but now you also own the equity in that sector as well. And so imagine, I like to think of this scenario like in, March 2020 during COVID, demand for oil dropped off a cliff. The price technically went negative for a sec. Imagine you got laid off from your job. Not only is like you're seeing your stock portfolio drop, but you're seeing oil and gas getting hit really bad in your portfolio, and you just lost your job. It's like a double whammy. So the question is, why don't we customize your portfolio? Why don't we give you the S&P 500, but we reduce your exposure to energy and oil? So imagine taking it out of the portfolio completely, right? The S&P 500, but no energy companies, right? Now, you can do this today. It would be kind of difficult. I mean, you would have to go and individually pick stocks. There are solutions for this called custom indexing, where you can imagine creating a portfolio and then selecting out different sectors. And that's kind of where I think the future is headed, is kind of creating these custom portfolios for individuals based on their life circumstances. But we're not there yet. For most people, this is not easy to do yet. This is like a fancy tool that you have. I think in the future, this is going to be as common as anything else, as buying an ETF or something like that. So I think this is the future. Let's use another example. Let's say you have a large position in a single stock, like Apple, right? Right now, how would we, let's say you have this massive position, you've been a software engineer at Apple for a long time, you have all these shares, you don't want to sell them all down because you don't want to pay all the taxes, etc. What would we do for you now? We would just give you the S&P 500, and we'd also, you see this huge weight to Apple, which is already a couple percent of your portfolio. So why would you want to have even more weight to Apple? I'd argue you'd want to get the S&P 500, but you want to remove Apple. And actually, to take this a little further, not only would you want to remove Apple, but you'd probably want to reduce the weight of things that are like Apple. So maybe reduce the weight of Microsoft or Google or Amazon, etc. You might want to reduce the weight of tech companies. So you'd want to overweight everything that's not like Apple and underweight or downweight everything that's like Apple to offset the risk of owning all this Apple, right? You can imagine it's like really just trying to balance your portfolio better. And I think this is kind of the way forward. This is how things are going to be done in the future, right? So the future of retail investing, I believe, is customization. It's more control over what risks you want to take, right? And so, as I said, in the case of the oil and gas industry person, like, do you want to take equity risk in oil and gas? I'd argue no, right? I work at a financial services firm, and I just own things like the S&P 500. I'd argue I should probably reduce my risk to financial services. I should have more stocks that are not correlated, that have a lower beta, because as the market drops, my firm is going to be adversely impacted, my compensation could be adversely impacted, etc. So there's a host of reasons why I'd want to kind of diversify away from this in some way, right? So I still own stocks, but maybe I wouldn't own as many financial services stocks, for example. I also think future retail investing is going to be based on your preferences. Let's say you don't want to support a particular, let's say, for example, gun rights or something. You don't really believe in, gun manufacturers. So you take those out of your portfolio. Right now, this is called ESG. This is kind of getting a bad rap in the US, but I think we're going to call it preference-based or values-based investing in the future. I could see that kind of being important. I also think the future of retail investing is better reporting. You're going to have a better understanding of why did my portfolio outperform or underperform over a given period of time. We're going to understand the exact components. Right now, when you own an index fund, you're like, oh, I just own the index. But let's say you customize your portfolio, you're going to be able to say, hey, you outperformed or underperformed because of this specific thing. And I think technology is making that easier. And lastly, the future of retail investing is probably going to be cheaper than it is today. There's just been a trend that's been, lowering costs over time. This all started with, Vanguard really is the pioneer of this stuff where, things have been getting cheaper over time. And I think it's going to keep going that way. Technology is making it easier. Trades are basically free at this point. Like, that's the trend of the future of retail investing. So with that being said, this is the kind of first half of the talk where I talk about the future of retail investing, talking about customization, talking about why I think us all buying the same fund is kind of archaic. But putting that aside, that's where I think the future is going. We'll see how that plays out. The next part of this talk is called How to Grow Your Wealth in the 21st Century. And so despite what the future is going to hold, we don't know. I think there are some things we can learn from history about how to grow your wealth and what will work in this next century. And the way I use, my philosophy on this is a 3-word philosophy. It's just keep buying. And I actually have a mantra that defines what this means. When I say just keep buying, what does that mean? And in particular, it means the continual purchase of a diverse set of income producing assets. I will say that again. The continual purchase of a diverse set of income-producing assets. And before we talk about the continual purchase part, I will explain what that means a little bit later in this talk. But the first part I want to talk about is a diverse set of income-producing assets. What are we buying and why are we buying it? And so there's a host of different income-producing assets you can own. There's this list here, which I'm going to walk through, right? And I don't think there's a right answer to this. I don't think there's a perfect mix of income-producing assets you have to own. I think people have gotten rich owning all of these types of things, and it's just about figuring out what works for you. So let's walk through some of these. In terms of income-producing assets, you can own things like stocks, which I've talked about at length in this talk, right? Through ETFs or index funds, that's how you stay diversified, and you own a diverse set. Bonds, whether that be, in my case, U.S. bonds, because I think they're the lowest risk asset out there, because the U.S. can just print more money. You can own foreign bonds as well. It's all up to your preference. Things like real estate, whether that's owning your own property or investing in real estate, having a vacation rental, having just an investment property of some sort. Things like farmland, which is trying to take off in the US. I'm not as familiar with how that works in Europe, but owning a farm and having something that's not as correlated with stocks, bonds, and real estate, right, which are the 3 main asset classes that most investors, at least in the United States, own. Owning a small business, or whether as an operator or giving capital to someone or someone you've met and having them run their business, right? And just owning the shares. So there's different ways of going about that. Owning royalties. This is something that's starting to take off. It's usually for investors that have a little bit more capital, but you can buy the royalties to a song, right? So imagine a song, every time it gets played, you get paid a little bit of that royalty income, right? lastly, your own products, right? Create income producing assets, create your own products. In my case, I have a book, I have a blog, right? I have things that I'm putting out there, and that's helped me earn some income, which is great. There's different trade-offs of owning all these things, right? The reason I like stocks and why stocks are my favorite is because they're very passive. Once you own them, like the money just, they grow over time, you get paid dividends, etc. Like it's very easy, right? In an ETF or an index fund, right? You can do this through real estate where you can have leverage and you can, make more. And there's definitely ups and downs of all of these asset classes. I think with real estate, the thing that's been tough for me is just there's what I call the return on hassle. It's not my term, but I've heard it before. Return on hassle. It's like owning an investment property can be tough, right? Imagine you have to deal with tenants, or you have to deal with a vacationer who wrecks your property, right? So there are things you have to deal with owning some of these asset classes that you don't have to deal with others. And so for me, I like it nice and easy. This is why stocks are my favorite, right? And additionally, why stocks are my favorite, if you just think about what a stock represents, it represents a share in a slice of a business, right? So in this case, let's go back to the Amazon, Tesla, Apple example. In each one of these cases, if you own a share of Amazon, you own a share of the future profits of that business, the future cash flows of that business. And all of the people inside that business are technically working for you, right? People like Jeff Bezos, Elon Musk, Tim Cook, people who are great operators who've done well in their fields. They are working for you, right? They're helping to grow those companies. And you as a small part owner, even of a very, very, very small slice, they're technically working for you. And they're working to make you richer. This is why I'm such a big proponent of owning stocks, right? Because all of those people are working in some small way. They're working obviously for their own self-interest, but you as an equity owner, you own the slice of that business, you're getting paid off that as well. Once again, we can extend this. Why not? Why own those three companies? Why not just own all the companies, let's say in the S&P 500, all US stocks, right? And once you do that, all of these people and all of these companies are working for you, right? And it's a kind of a very unique idea of saying like, hey, all these people are really working to make me richer. And you can take this and you can expand it even further, which is like, hey, not only would you have US companies people in US companies working for you, but once again, you can have people across the globe working for you. You can have people in companies in India, China, Japan, Europe, etc. United States, all working to make you richer. And when you really break this down, what does this mean? It's really owning the economic output of human civilization. I think that is the core idea for why I love stocks so much, especially global stocks. I'm a big fan of owning international stocks, even though they haven't done as well, and we'll get into that in a second here. And I think it's just because this idea of saying, hey, I want to have a dividend or own a slice of the economic output of human civilization. And by owning global stocks, you kind of get at that. And I think there's something to that, and it's believing more fundamentally in the human spirit, human ingenuity, and everything we can do. And that's why I own stocks, right? So with that being said, this is the mantra for Just Keep Buying, the continual purchase of a diverse set of income producing assets. I've talked a little bit about, the diverse set of income producing assets, the different assets you can own. I don't think, as I said, there's a correct way to do this. I think it's about finding what works for you. If that's real estate, great. If it's stocks, great. If it's farmland, royalties, etc., whatever works for you is what you need to do, or is what you need to invest in. Now let's talk about the continual purchase part. I think this part is just as interesting. And so we'll start with an example. So this chart shows the future real returns annualized over 5 years of US stocks over time. This is from, I think, 1881 to like 2016. And what it shows is the future returns, right, after inflation, but dependent on the price to earnings ratio. So for those that haven't heard of the price to earnings ratio, it's basically a measure of how expensive things are, right? Like how much are people willing to pay for earnings? So more or less, if things on this side of the x-axis are expensive, things over here are cheap. And as you can see, roughly, if you had to draw like a fit line, like a regression line through this, the line would be somewhat downward sloping. When US stocks are cheaper, generally they have higher returns than when they're more expensive. I agree with that. I think the data shows that pretty clearly, especially over a 5-year period, right? You can see that as stocks get more expensive, they generally, as people bid them up, their future returns are lower, right? However, what if we were to extend this out beyond 5 years? What if we were to go to a longer period, let's say over 30 years? Well, over a 30-year time period, these returns kind of converge in some way. Now, of course, there's still big differences between a 10% return and like a 2% return over 30 years. Those can be quite different. There still is some downward slope here. But the point is, even in the most expensive periods, US stocks have had real returns in the order of, 5 to 6%, even in the most expensive periods. So it really goes to show that, like, no matter when you buy, it's about buying over time because you're likely to make money. Now, some will say, well, Nick, you're using the US. The US is a complete outlier. Why don't you use someone else? And so I'm like, okay, let's use the poster child for bad equity returns or poor performance is Japan. And Japan had one of the worst bubbles of all time. I would actually say the biggest asset bubble of all time. And you can see this just in their stock market data. So as you can see here, from 1980 to 1989, there was this huge melt up, this huge bubble that happened, and that bubble popped. And through today, the Japanese stock market has still not returned to its high in 1989. It's been over 30 years now, 33 years basically, and it still hasn't come back to its 1989 high. But my counter to this is, there's a few counters. The first counter is that, this was one of the most expensive markets in history. And you can actually see this by comparing the US stock market during the dot-com bubble. That's what this blue line shows. It says, hey, let's index the stock market to, for the dot-com bubble and show its peak here. And let's compare that to the peak in Japan. Let's kind of index that over the same time period to find that peak. And as you can see, over this time period, the U.S. stock market at its highest had a PE ratio, which is, remember, a measure of expensiveness. So higher is more expensive, lower is cheaper. Had a PE ratio of about 40. But Japan in 1989 had a PE ratio of almost 100. It was almost 2.5 times more expensive, right? So I think using Japan as a counterexample is not a great example because it was the most expensive market ever, the biggest bubble of all time. You can see that, like, the PE ratio came down considerably, but it was still super high, and then it just dropped even more, right? So as investors woke up. Secondly, people don't invest in snapshots. I mean, this is a terrible return if you put in all your money right here in 1989. If you just put it all in and just let it ride, yes, this would have been one of the worst returns you could have ever had, one of the unluckiest investors in history. But that's not how people invest. People are buying over time. Most people are taking their paycheck and buying over time. This is true in the US, it's true in most markets, right? So what happened if you just invested consistently over time in the Japanese stock market? Well, the story's a little bit different, right? Let's say you put $1 per day into Japanese stocks over this time period, right? That's what this gray line is. This is called just the cost basis. How much money have you put in over time? So you can just imagine putting money in your portfolio. So over the course of, this period, you would put in a little bit under $10,000 over the course of this entire period, right? And this black line shows the market value of your portfolio. So early on, they're similar, but look, as the bubble starts to inflate, you can see by 1989, the market value of your portfolio reached almost $8,000, even though you'd put in only about $2,500. Obviously, the bubble deflates, you're still adding money over time, and at some point, the market value portfolio is actually under the amount of money you put in. So you've technically lost money on, based on how much cash. It's below the cash value you put in, right? But you kept investing over time, this would have come back to the point where you actually have outperformed just sitting purely in cash over this entire time period. Now, I'll admit, this is not a great return. You don't want to see something like this. You should never want to see your market value dip below your cost basis, and especially not for this long. This is a very rough period, I'm not going to lie. But this is the worst example in history. I'm literally using the biggest outlier on the downside and showing, even if you kept investing over a long period of time, the continual purchase, right? You continually buying things, you would have actually beaten just sitting in cash. Now, the question is, like, okay, I've shown you the US, I've shown you Japan. What about other markets? Like, what does this look like around the world? And I think, some of these charts will be a little bit more illustrative of what, normal equity returns are like across most markets. This here shows the growth of $1 invested in the US, Australia, Canada, all these countries here, and Poland, we'll get to that in a second, from 1993 to 2022. And as you can see, this is ranked by the best performing to the worst performing over this period. You can see Italy was the worst performing. If you just put $1.93, they've done the worst, right? But what's interesting about this chart is you can see, like, there's generally growth in these markets. Yes, there's a huge variation, but there's generally been growth. More importantly, given this is the Warsaw Investment Conference, let's talk about what happened in Poland. I think if my understanding is correct, the Polish stock market reopened, I think, in 1991, and since then it's been a series of booms and busts, right? So there's a huge run up. Look at this, almost 10x within, over 10x within a few years. That crashed, again up through 2008. There's an even bigger boom and then another bust, and the market has not recovered since 2008 overall, right? I think it's interesting to look at this, like, yes, this looks bad and there are moments where this is not great, but just if we just aggregate all this data, take all this noise jumping around, what does this mean just on a annualized basis? What would your return have been if you had started investing in 1993? And this table shows that. So This shows every country listed, and it's in order of their annualized return and then their real annualized return. So after inflation, U.S. inflation, right? What would have happened, right? And so you can see the U.S. had a realized return of 7%. Poland still had a return of 5% despite all the ups and downs, right? And Italy was the worst at 2.8%. And so the general trend is, okay, take the U.S. out, there might be an outlier, right? Take Italy out, there might be an outlier. Most of the return, like the typical long-term realized return of global stocks should be somewhere in the 3 to 6% range. And I think this is a fair estimate going forward for real annualized returns for stocks around the world, right? 3 to 6%. The equity risk premium, which was estimated by I think DFA had an equity risk premium, some data where they showed that it was about 4 to 5%, right? And it varies, across countries. But this is about how much you should expect to return above bonds, right? So this is kind of what I like to use. Like 3 to 6% is what you should expect to get, right? And looking at the U.S., you're like, well, the U.S. is an outlier. Is there some sort of U.S. Supremacy, U.S. stock market supremacy? And like, if we look since from 2009 to 2022, this is the story, right? Like, oh my gosh, the U.S. has crushed everyone else. The U.S. is greater, blah blah blah. But this is just a snapshot once again. Using this chart, you would say, wow, why would I invest anywhere except the U.S., right? And you'd say, oh, I would never want to invest in Poland. Look at how terrible these returns are. Oh, from 2009 specifically, it's not great. I will admit that. However, let's go back one decade before this. Instead of going from 2009 to 2022, let's go from 2000 to 2009. And you can see the story is very different. Now the U.S. is at the bottom, Poland somewhere in the middle. Like, this is a very different chart. And it goes to show that, like, there is some sort of mean reversion. I'm not saying everything will mean revert, but like, just because something's doing really well now doesn't mean it was doing well earlier. So this is why diversification is important, right? Owning the U.S. here seems like a genius idea, but owning it here is not so great. But once again, these are only showing snapshots. A growth of a dollar plot is saying you put $1 here and you never invest again. The question is, what about if you're buying over time? How does that change, the calculus? How does that change the results? And I think it changes it in a big way. And so what these charts show, this is showing a $10,000 annual investment. It's actually done monthly. So $800, $867 a month over the course of 30 years. So in total, each one of these charts has $300,000 invested in it, right? That's what this black line is. Imagine just doing $10,000 a year, do it monthly and do it over the course of 30 years. So this point here is $300,000 on each of these plots for each one of these countries, right? So if I invest in Australia or India, $10,000 a year over time. Here's the cost basis. This is just your portfolio value. And the green line is showing the market value. And as you can see, there are some countries like US and India where the market value is far above what you put in. Even though you only put in 300,000, the market value is at about 1.5 million in India and the United States, right? Over this time period. Remember, it's a 30-year time period. However, there's places like Italy and Poland where, it hasn't done as well. But still, even when you include, investing over time, every single one of these markets beats sitting in cash. Even Poland here, yes, all of them had outperformed just putting your money into a savings account and not getting any interest on, or basically no interest over this time period, right? So just having that, investing in these stock markets would have actually earned you money, right? You would have actually made money in all these markets. On an inflation-adjusted basis, even if we adjusted these dollars for inflation, 8 out of these 9 markets, only Poland was the only market where even after inflation, you didn't really beat inflation, right? So after accounting for that. But still, like, let's think about that. In the worst case, okay, you basically match inflation. Maybe you're a little under inflation. And in the best case, you make way more. You make, 5x on your money or something, or 3x on your money after inflation, right? So this goes to show, like, these are the range of returns I would expect going forward. Like, in the worst case scenario, you'll probably just match inflation. In the best case scenario, you're looking at growing your purchasing power in a very big way, right? And so I wanted to show these plots because this shows when you're buying over time, like, even if you go through a bad period, you can still have really good returns in the long run, right? So it's something to keep in mind. And once again, I think that 3 to 6%, 3% a year doesn't seem like a lot, but after you adjust for inflation, like, that adds up over time. Like, it's not the best, but it's one of those things where, hey, you're building wealth, right? And that's the point here is, like, if you expect, 4 to 5%, inflation adjusted growth over time, I think you will do fine as an investor. But with that being said, some markets do poorly, but not all markets. That's the key here. Yes, you might get unlucky with one market or another. That's why we diversify, right? So overall, just keep buying is the philosophy I support. I think it's easier now than ever before because we have free trades. Things are cheaper than they've ever been, right? Like, we have cheap diversification. It's much easier to get into other markets, right? And so I think that's the thing to keep in mind is like, and it's going to get better. Like there's going to be more and more capital flows across the world, right? And even though there's not access to every capital market for every investor in every country, I think this is going to change in the future. Most importantly, Just Keep Buying is backed by data. I just showed you some data from 1993 onward, but there's so much data on this. There's a great book called The Triumph of the Optimist. If you want to check this out, that they've done, a century's worth of data looking at a bunch of different stock markets. And as I said, most of them, some markets do poorly, but not all. Most of them do well, do decently well. That's the key here. If you want to learn more, my book is out in English, and it will also be out in Poland sometime this year. I think in the next couple months, it will be releasing it. So that's it. Just keep buying, and thank you for your time. And by the way, if you want to reach out to me, my Twitter is @DollarsAndData. My Instagram is at Nick Maggiulli. I think that'll be circulated, and you guys can reach out to me anytime. I try to answer every DM I can. And don't worry if your English isn't great. We'll figure it out. I've talked about investing enough. I've seen enough questions. If you just say a couple keywords, I bet I can get what you're getting at. So thank you for your time.